So I want you to imagine a company, but not just any company. Imagine a company that makes the software running a regional chain of bowling alleys.
Right.
Or, the dispatch system for a municipal ambulance fleet. Or maybe the accounting backend for a very, very specific type of dental practice.
Highly niche stuff.
Exactly. I mean, it sounds incredibly boring, right?
Yeah.
You aren't going to see these products trending on social media. And they certainly aren't building the next massive artificial intelligence chatbot.
Definitely not. It's the plumbing of the business world.
Yeah, the plumbing. But now imagine that same boring company is worth nearly $39 billion.
It's staggering.
It is. And it's minted millionaires out of its early investors. But, and this is the huge boat we're getting into today, it's currently sitting on this subtle kind of hidden financial fault line that could fracture its valuation at literally any moment.
Yeah, we are looking at an absolute masterclass in capital allocation, but one that is, well, it's colliding head-on with the unforgiving realities of scale and, just massive market expectations.
Okay, let's unpack this. Today, we are doing the ultimate buy-side stress test on Constellation Software. So for those of you tracking the tickers at home, that is CSU in Toronto and CNSWF over the counter in the U.S.
Right.
And we are not here to do some, standard surface-level summary of their business model. We have a highly detailed skeptical buy-side framework report sitting right in front of us.
And it is thorough.
Very thorough. So our mission for you, the listener, is to figure out if this legendary technology consolidator is actually a good investment right now, today, in early 2026.
Because, the central tension of our entire analysis here really rests on a crucial distinction. There is a massive, massive gulf between a great business and a great investment.
Oh, that's a great way to put it.
Yeah, because Constellation is, without a doubt, an exceptional business. It has this unusually durable cash generation engine.
Right.
But the complication is that at its current market price, the stock embeds incredibly demanding expectations. The market is basically pricing in flawless, perpetual execution forever.
Perfection. They're pricing in perfection. Which means the burden of proof is entirely on the company to justify that premium, right?
Exactly.
If you're paying a top-tier multiple, you need premium execution just to break even on your expectations, let alone actually generate market-beating returns. So let's start by looking at the actual engine driving this valuation.
The compounding machine.
The compounding machine. Constellation's entire identity is built on acquiring, managing, and building vertical market software, or VMS. And by the end of 2025, their total revenue hit a staggering $11.6 billion.
Which is it's a massive scale for a company made up of tiny little niche software components, spread out across the US, the UK, Europe, Canada.
Yeah, it's an empire of tiny puzzle pieces.
Yeah.
But the quality of that $11.6 billion, that's the absolute cornerstone of the bullish narrative here.
Oh, absolutely. Roughly 75% of that revenue is classified as maintenance and other recurring revenue.
75%, that's huge.
It's massive. And furthermore, their customer concentration is phenomenally low. Like if you dig into the audited notes from their 2025 and 2024 financials, not a single customer exceeds 5% of their total consolidated revenue.
So if one local government goes bankrupt or, I don't know, a chain of fitness centers goes under,
Constellation barely feels a breeze. It's incredibly insulated.
But I want to dig into this concept of recurring revenue because the skeptical framework we're using today forces us to realize that, well, recurring does not mean guaranteed in perpetuity.
No, it definitely doesn't.
Historically, the stickiness of this VMS revenue isn't because the software is just a joy to use. Like often it's legacy software.
Oh, yeah. A lot of it looks like it was built 2 decades ago. Clunky interfaces, gray screens.
Exactly. The stickiness actually comes from the sheer operational pain of replacing it.
Yeah, think about the day-to-day reality of a 911 dispatch center, for example. The software they use is mission critical. If it goes down, lives are literally at risk.
High stakes.
Incredibly high. So if that municipality wants to switch to a cheaper competitor, they have to rip out the foundational architecture of their emergency response system.
Which sounds like a nightmare.
It is. They have to retrain hundreds of stressed dispatchers on a totally new interface, and they risk catastrophic bugs during the actual migration. The switching costs are astronomically high.
So when Constellation implements like an annual price increase on the maintenance fee, the municipality just They just pay it.
They just pay it. It is so much easier to just grumble about a 5% price hike than to risk a total system failure.
That operational pain is the ultimate moat.
Right, but
And here's the skeptical framework kicking in. It warns us that under severe macroeconomic stress, this dynamic begins to shift, doesn't it?
it does. When these local businesses or municipal governments face serious budget crises, they might not cancel the software outright because they can't, but they will actively fight those annual price increases.
They start pushing back.
Exactly. They push back against maintenance escalators, they delay upgrading to newer modules, they stretch out their hardware replacement cycles as long as humanly possible.
Which ultimately translates into margin pressure for Constellation. Even if the core revenue technically remains on the books, it's less profitable.
Precisely. And this tension brings us to a really crucial divergence in their numbers. It's the reality check on their organic growth.
Right, the 2025 numbers. Break those down for us.
So in 2025, total revenue grew by an impressive 15%.
Which sounds great.
It sounds fantastic. But organic growth, which measures the growth of the businesses they already owned, without counting the new ones they just bought, that was a meager 4%.
Wow.
And if you adjust for foreign exchange rates, it was really just 3%.
Okay, so a 15% top-line expansion masking a 3% organic reality.
No, it's a huge delta.
It kind of paints a picture of a shark that absolutely has to keep swimming to breathe, right? Like, if they don't continually swallow up other companies, that 3% organic growth is fundamentally incapable of sustaining the massive valuation multiple the market has assigned them.
That's the perfect analogy. The entire compounding machine relies completely on the internal rate of return, or IRR, of their acquisitions.
They take the cash from the slow-growing old businesses.
Right, and they deploy it to buy more businesses. If that acquisition engine slows down, or if the returns on those new acquisitions compress, maybe because interest rates rise, or private equity firms increase competition, the compounding math breaks down rapidly.
But wait, analyzing that very IRR is notoriously difficult, isn't it? Because Constellation intentionally hides it.
They do. They limit their disclosure heavily. They don't publish a neat little spreadsheet showing exactly what they paid for every single company and what the specific return was.
Why not?
They claim that Constellation emulators, competitors trying to replicate their exact roll-up strategy, are a primary business threat. So they keep the cookbook locked securely in the vault.
I mean, competitively, limiting that disclosure is a highly rational defense mechanism. If you've built a proprietary system for identifying and pricing niche software, you don't want to broadcast your metrics and invite competition.
Absolutely rational for management. But from the perspective of a buy-side investor, it forces you to operate on an immense amount of blind trust.
Yeah, you're underwriting a valuation based on an internal engine that is becoming increasingly opaque.
Right. The source material advises that the only way to safely navigate this opacity is to ruthlessly ignore the whole narrative of an impenetrable moat.
Just ignore the story.
Ignore the story. Investors have to focus entirely on the audited cash outcomes and actively hunt for error signals in the cash flow statements.
Okay, so if the entire model relies on this highly disciplined, highly secretive M&A process, then the person steering that machine is the most critical variable in the equation.
Without a doubt.
And that brings us to a monumental shift in the company's story. The legendary founder, Mark Leonard, resigned as president in September 2025, citing health reasons.
A massive event for the company.
And following his departure, Mark Miller, the former chief operating officer, was appointed president and then added to the board in December of that year.
We really have to contextualize Mark Leonard's influence here to understand the gravity of this transition. I mean, he was not a standard corporate executive.
Not at all.
He was the philosophical architect of this entire capital allocation culture. He instilled this rigid framework of decentralized autonomy, extreme frugality, and just unemotional discipline in how capital was deployed.
But he had serious skin in the game, right?
It's unbelievable skin in the game.
Yeah.
To permanently signal his alignment with long-term shareholders, he famously waived his salary and his bonus entirely from 2022 to 2024.
He worked for free, purely to compound the value of his equity alongside the public shareholders.
Exactly. That level of alignment is nearly unheard of in modern public markets.
Crazy.
So Constellation's entire reputation as this compounding machine was built under his specific unyielding discipline. His departure introduces the absolute highest priority risk highlighted in the report: key person risk.
So even if Mark Miller is an exceptional successor, and all evidence suggests he knows the operational playbook intimately, a founder transition of this magnitude inherently alters a company's risk posture.
It is a fundamental regime change. The skeptical investor must treat the post-September 2025 era as an entirely new statistical environment until proven otherwise.
Here's where it gets really interesting to me. If you think about it, Miller stepping in for Leonard is like a new coach taking over a dynasty.
Right.
The playbook is still sitting in the locker room, the assistant coaches know all the drills, but in the final seconds of a championship game, when the pressure is just immense, does the new coach make the exact same ruthless, high-probability call that the founder would have made?
And that is the precise mechanism of post-founder drift. It rarely manifests as some sudden catastrophic failure. It's usually a gradual, subtle softening of discipline. We call it the risk of strategic deviations.
Strategic deviations. Give me an example of how that happens.
Okay, imagine Constellation is in a bidding war for a high-quality software asset. Under Mark Leonard, the historical data suggests they had a hard walk-away price. If the internal model said the asset was worth $30 million, they walked at $30.01.
No emotion.
No emotion at all. But under new management, facing immense pressure from Wall Street to maintain that 15% top-line growth, the rationale might shift.
They might talk themselves into it.
Exactly. They might argue, well, it's a strategic asset. It opens a new vertical for us. We can stretch the bid to $32 million.
Just a little bit more.
Just a little. But then a year later, they stretch to $35 million. Slowly, they start justifying the acquisition of lower return assets simply to keep the growth optics alive for the market.
And the cascading effect of those small deviations is severe, isn't it? The internal rate of return on that deployed capital drops, and the foundational math of the compounding engine just starts to deteriorate.
That's the danger. The burden is now entirely on Mark Miller to prove the historical discipline remains intact. Investors can't just assume the next decade will look like the last one.
So what keeps this new management team aligned with shareholders now that the founder's unique example is out of the day-to-day picture? What are the actual incentives?
Well, Constellation does utilize an unusually strong incentive design for a public consolidator. The executive bonus is heavily focused on return on invested capital, or ROIC, and net revenue growth.
Okay, so they're measured on the right things.
Yes. And the standout feature is that executives are required to invest roughly 75% of their after-tax incentive bonus into Constellation shares.
Wow, 75%.
Yeah, and those shares are held in escrow for an average of 4 years.
Okay, so locking up 75% of a bonus in company stock for 4 years, that creates undeniable structural alignment. They are intensely exposed to long-term consequences of their own capital allocation decisions.
They are. However,
There's always a however.
there is always a however in the skeptical framework.
Yep.
We have to stress test the actual metric calculating that bonus pool. The bonus is based on a non-IFRS metric specifically defined by the company as net income for bonus purposes.
So it's a custom accounting metric they define themselves. It's not strict adherence to standard international financial reporting standards.
Right. And custom metrics are a subtle vulnerability, especially as a company scales in complexity.
How so?
Management teams can adjust this non-IFRS net income for a variety of items. They can adjust for deferred taxes, foreign exchange fluctuations, or bargain purchase gains.
So if the core cash economics of the business begin to face headwinds, they can use these adjustments to sort of smooth out the apparent performance.
Exactly. It effectively creates a parallel earnings universe. It becomes a subtle trust me lever that determines executive compensation. The buy-side investor has to constantly monitor whether the goalposts are being subtly moved to ensure the bonus pool continues to fund, even if underlying cash generation is getting harder.
And that pressure to keep the cash flowing and the business growing leads directly to a massive structural challenge. Because if Miller wants to prove he can match Leonard's returns, he has a mountain of cash he is practically forced to deploy, right?
Yes, and that creates a whole new nightmare. Mark Leonard actually explicitly discussed this in his 2021 shareholder letter.
The excess cash problem.
The excess cash problem. He detailed their historic inability to invest all of their internally generated cash at their strict traditional hurdle rates. They simply generated more cash than they could effectively deploy into tiny, perfect VMS companies.
It's a good problem to have until it isn't. So what was the proposed solution to all that excess cash?
A strategic pivot into very large deals, and potentially expanding outside of their traditional vertical market software niche entirely.
And we are witnessing the execution of that pivot today. And the risks are fundamentally different. The source material highlights the recent acquisition of Altera.
Yes, Altera. It's a healthcare IT platform. And they bought it for roughly $725 million plus potential earnouts.
725 million, just to put that in perspective for you listening. Their traditional playbook involved buying tiny founder-owned software businesses for perhaps $5 or $10 million.
A completely different scale.
Moving from $10 million deals to a $725 million platform, that is a completely different operational sport.
It really is. Buying a massive platform like Altera introduces severe enterprise-level execution risk. You are taking on massive integration surfaces, you inherit incredibly complex R&D roadmaps, and because it's healthcare IT, you face infinitely heavier regulatory demands than you would with, a software tool managing a local bowling alley.
It really reminds me of an analogy. Imagine a highly successful local real estate investor who has spent 20 years making an absolute fortune buying single-family homes in one specific zip code.
Okay.
They know the local plumbers. They understand the hyper-local zoning laws. They know exactly what rent the market will bear. They're absolute masters of that specific domain.
Sure, they have an edge.
Right. But suddenly, their fund grows so large that they decide to deploy their excess capital into a massive 80-story mixed-use skyscraper in a foreign country.
Yes.
The underlying asset class is technically the same. It's still real estate, just as Altera is still software. But the variables governing success are entirely different. The specific expertise that drove the historical returns does not cleanly translate to the new massive asset.
That is the canonical failure mode of great compounders. It really is. They remain operationally sound in their core legacy business, but the marginal dollar, the next dollar they are forced to invest, finds lower return uses because they've expanded their circle of competence too far.
And the complexity isn't limited to just massive healthcare platforms. The report digs into some incredibly intricate financial engineering happening within the broader Constellation ecosystem. Let's talk about Asseco Poland.
Right, the Asseco Poland situation. They have built these highly complex equity and derivative positions tied to Asseco Poland, and they facilitated this via their Topicus spin-out ecosystem.
And the initial cost package for that was roughly $588 million, right?
Correct. And the structural complexity here creates immense valuation opacity for the public market investor. Constellation has engineered this web of controlled public subsidiaries and non-controlling interests, specifically through entities like Lumen Group and Topicus.
Okay, I want to spend some time breaking down exactly how that obscures the cash, because to a normal retail investor looking at a brokerage account, terms like non-controlling interests just sound like accounting jargon.
It does. Let's trace the hypothetical path of a single dollar of revenue generated in that ecosystem to make it clear.
Okay, follow the dollar.
Follow the dollar. If a software company in Poland generates $1 of profit, that dollar doesn't flow cleanly and directly into Constellation's parent bank account in Toronto.
Where does it go?
It flows through the local operating company up into the Topicus subsidiary structure, and because Constellation does not own 100% of that structure, there are other public shareholders and non-controlling interests involved. Only a specific fraction of that dollar actually belongs to Constellation's shareholders.
Think of it like a pizza.
Exactly like a pizza. Constellation baked the pizza, but they only own 3 slices of it. The other slices belong to the minority shareholders of the spinout.
So when I pull up Constellation's consolidated financial statements, what am I actually looking at?
You're looking at a mashed-up average. You are seeing the revenues of wholly owned businesses blended together with the partial economics of these spinouts, layered over the mark-to-market volatility of the financial derivatives tied to Asseco Poland.
Which makes it incredibly difficult to isolate the true cash-on-cash return of the core business.
Extremely difficult. By pushing the boundaries of their competence to include complex financial derivatives and massive healthcare platforms, they are taking on risks completely absent from their historical small deal playbook.
So, to determine if this structural complexity is hiding real economic decay, we have to peel back the layers of their audited financials.
Yes.
Right? We have to look at the underlying trends, not just the raw top-line data.
Let's get our hands dirty with the 2025 audited numbers.
Yes, let's do it. What's the first major red flag the report identifies?
The massive scaling burden of intangibles. In 2025, their amortization of intangible assets approached $1.2 billion.
$1.2 billion. That is a massive number.
It is, and that number is climbing year over year. They also recorded $11 million in goodwill impairment, alongside other non-financial asset
Okay,
impairments.
let's define that for the listener. For any company utilizing an aggressive M&A roll-up strategy, intangibles are an unavoidable reality on the balance sheet, right?
Yes, it's just how the accounting works. When you acquire a software company for a price higher than the fair value of its physical assets, the desks, the computers, the server racks,
Which isn't much for a software company.
right, hardly anything. So that massive premium you pay is recorded as goodwill and intangible assets. It represents the perceived value of the acquired customer relationships or the proprietary tech.
So the economic question isn't really whether impairments will occur. If you execute hundreds of acquisitions, a certain percentage will inevitably underperform and require a write-down.
Statistically, yes, you're going to have some losers.
The critical question for investors is whether these climbing amortization figures and impairments are just the natural proportional footprint of a massive model at scale, or if they represent the delayed realization that the company has been systematically overpaying for finite-lived cash flows in recent years.
And that tension introduces one of the most vital and, frankly, subtle insights from the management's discussion and analysis portion of the filings. Constellation tests for impairment based on valuation multiples applied to annual recurring revenue, or ARR.
Okay, this is a mechanism we really need to completely unpack.
Yeah.
How does testing impairment against an ARR multiple create a vulnerability?
Consider the feedback loop it generates. Let's assume the broader competitive environment for software assets gets incredibly hot.
Like 2021 all over again.
Exactly. Private equity firms raise billions in fresh capital and begin aggressively bidding up the prices of vertical market software companies. Because everyone in the market is suddenly willing to pay more, the prevailing market multiples for ARR rise across the board.
So a company that historically traded for, say, 3 times its revenue might suddenly command a price of 5 times its revenue simply due to macro liquidity.
Yes, so the baseline cost of acquiring growth goes up for Constellation. Now, management can point to these new, elevated, market-driven ARR multiples to justify paying higher prices for new acquisitions. Hey, the market says it's worth 5x, so we paid 5x.
Sure, that makes sense on the front end.
But the real danger lies in how those same elevated multiples are applied retroactively. They can utilize those higher market multiples to defend against writing down the older, decaying assets already sitting on their balance sheet.
Wait, let me trace the math on that. Suppose Constellation bought a company 5 years ago, and over time, that company has just struggled. Its actual revenue is shrinking.
Right, it's a dud.
Under normal circumstances, they would have to take a significant impairment charge. They'd have to publicly admit a loss on that specific deal.
Exactly. Take the hit on the income statement.
But because the broader market is suddenly willing to pay a much higher multiple for any software revenue, management applies that inflated market multiple to their struggling assets' shrinking revenue.
Mathematically, yes. The theoretical value of the asset remains high enough on paper to avoid triggering the impairment threshold.
Wow, so the accounting surface looks perfectly stable, the auditors sign off, and there are no massive headline-grabbing write-downs to spook investors.
But the underlying economic reality, the actual cash-on-cash return generated by those aging assets, could be eroding significantly. It is functionally grading your own homework using a curve dictated by the speculative behavior of outside private equity firms.
Grading your own homework on a curve. If the broader market is overpaying, it mathematically conceals your past acquisition mistakes.
It's a phenomenal way to hide decay in plain sight.
That ARR feedback loop is wild. And it's not the only area where the financials are becoming blurry due to estimation risk, is it? Look at how they structure the payouts for new acquisitions. The report highlights the $258 million acquisition of Sipple Shawbrook NV in 2025.
Yes, a very interesting case study in the filings. It specifically notes the use of provisional purchase price allocations and contingent consideration.
Which most people know as earnouts.
Earnouts, right.
Explain how an earnout actually functions in these deals.
An earnout is essentially a financial bridge to close a valuation gap between a buyer and a seller.
Okay.
Let's say the seller believes their company is poised to grow 20% next year, and therefore they demand a $300 million purchase price. But Constellation's internal models project only 5% growth, suggesting the company is only worth $200 million.
So they're $100 million apart.
Right. To close the deal, they compromise. Constellation pays $200 million upfront and promises to pay the additional $100 million in the future, but only if the acquired company actually hits that aggressive 20% growth target. That contingent future promise is the earnout.
I mean, operationally, it makes perfect sense. It protects Constellation from overpaying based on a founder's overly optimistic projections. If the growth doesn't materialize, they just don't pay the extra cash.
From an operational risk standpoint, it is highly prudent. But from an accounting and valuation standpoint, it scales estimation risk massively for the public investor.
Awesome.
When a company heavily utilizes provisional allocations and earnouts, it means the true implied purchase multiple, the actual final amount of capital Constellation deployed to acquire that cash flow, remains unknown for months or even years after the press release.
Because you literally do not know the final purchase price until the future performance is realized and the earnout is either paid out or voided.
Exactly. It severely weakens near-term transparency. Furthermore, estimating the present value of those future earnout liabilities for the balance sheet requires management to make forward-looking assumptions today.
So they have to guess.
They have to model it out. If management adopts an optimistic posture regarding future payouts, it can subtly influence the current reporting of liabilities and expenses. It introduces a layer of estimation that distances the reported numbers from hard, immediate cash realities.
The blurriness of the accounting is just compounding the risk of the leadership transition. But there are also hard cash realities impacting the bottom line today, right? Two major points jumped out from the deep dive: tax rates and leverage traps. Let's start with taxes.
The consolidated effective tax rate spiked sharply in 2025, hitting an annual rate of 38%.
38%. That is a massive portion of their cash flow being handed directly to tax authorities.
It is, and the skeptical inference here is that this 38% rate is not just a temporary anomaly or one-off noise. As Constellation continues to scale globally, they are colliding with rising international tax complexity.
Like the global minimum tax rules.
Exactly. Global minimum tax rules, shifting regulations regarding where intellectual property is legally domiciled. Governments are systematically closing historical tax loopholes. They are becoming increasingly sophisticated at capturing revenue from digital and software assets.
And every dollar paid in tax is a dollar that cannot be reinvested. It permanently drags down the free cash flow available to feed the compounding engine.
Less cash retained means less cash available to fund M&A. It's a direct hit to the growth algorithm.
Okay, what about the leverage traps? Historically, Constellation has been praised for running a very clean parent-level balance sheet without a massive debt burden.
And they still do avoid heavy parent-level leverage. Instead, they utilize subsidiary-level non-recourse debt.
Break down the logic of that structure.
The architectural logic is to ring-fence risk. If a specific subsidiary takes out a loan and subsequently goes bankrupt, the lending bank can only seize the assets of that specific subsidiary. They have no legal recourse to come after the parent company, Constellation, or any of its other successful subsidiaries.
So it prevents a single bad deal from sinking the entire ship. Sounds smart.
In theory, it is highly protective. But the 2025 disclosure notes an administrative covenant breach at one of these subsidiary term loans.
An administrative breach, what does that mean?
The company categorized it as merely administrative, meaning it's not indicative of underlying operational failure, it's a technicality. However, it exposes the hidden fragility of this ring-fenced structure, especially in a high-interest rate environment.
How does an administrative breach translate into a problem for Constellation as a whole?
When debt is siloed at the local level, it comes with strict local covenants governing cash reserves and debt service coverage ratios. If a European subsidiary is facing temporary headwinds or simply triggers a technical covenant breach, the local lending institution can freeze the movement of capital.
Freeze the capital?
Yes. Constellation might have millions of dollars sitting in a bank account in Europe, but they are legally prohibited from moving that cash up to the parent company or redirecting it to fund a highly lucrative acquisition in the United States.
Wow.
The ring fence designed to contain risk suddenly becomes a prison. It traps capital and severely restricts the mobility of cash precisely when it might be needed most somewhere else in the empire.
I want to introduce a major counterargument here because we are really cataloging these structural risks, right?
Yeah.
Estimation risk, an inflating tax burden, trapped subsidiary cash, the massive key person transition.
Well, painting a bleak picture, yes.
Yet, amidst all of this, Constellation continues to pay a regular quarterly dividend. They declared a $1 per share dividend with their 2025 results. Doesn't the consistent payment of a cash dividend empirically prove that their cash position is rock solid? I mean, companies suffering from deteriorating underlying economics generally cannot sustain a dividend.
That is a very common perception. The dividend acts as a powerful psychological comfort blanket for many investors. It projects an aura of immense stability.
Sure, cash is cash.
But we must apply a harsh reality check based on management's own stated philosophy over the years. They have explicitly and repeatedly communicated that the dividend is purely a residual allocation of capital.
Residual, meaning it is simply whatever cash is left over after they have funded every possible acquisition they can find.
Precisely, and the implication of that is profound. If the M&A team identifies enough acquisition targets that meet their internal hurdle rates, they will ruthlessly sacrifice the dividend distribution to fund those deals.
Okay, but a bullish investor looks at a high reinvestment rate, the act of retaining earnings, rather than paying dividends as the ultimate wealth creator, right? Keep my money and compound it.
Yes, but the skeptical framework flips that logic entirely. A high reinvestment rate is only value creating if the acquisitions are actually earning a superior return. If they're expanding beyond their competence into massive healthcare platforms or complex Polish derivatives simply to keep the capital moving, then avoiding the dividend is actively destroying shareholder value.
They are retaining cash to fund progressively worse ideas instead of returning it to the owners.
Exactly. That is the ultimate test of the new management team under Mark Miller. Are they retaining cash because they genuinely have brilliant high-return ideas, or are they retaining cash because the machine is simply programmed to acquire at all costs?
And this analysis leads us directly into the multi-billion-dollar question for anyone considering allocating capital today. What price makes taking on these compounding structural and regime change risks actually worthwhile? Let's talk valuation.
Let's do it. We have to separate the intrinsic value of the business from the current price of the stock.
So at the time of this report, which is March 2026, CNSWF is trading at roughly $1,820 US per share. That yields a market capitalization of around $38.6 billion.
Right.
If we look at their 2025 free cash flow available to shareholders, which came in at $1.68 billion, we're looking at an enterprise value to free cash flow multiple in the mid-20s.
And a mid-20s multiple on uncommitted cash flow is a profoundly demanding valuation. It communicates that the market is currently pricing in near perfection.
What does that actually mean mathematically?
For a multiple that high to make mathematical sense, investors must believe three specific premises with absolute certainty. First, that the existing $1.68 billion in cash flow is incredibly durable and immune to macroeconomic erosion.
Okay, so no one cancels their software, no pushback on price hikes.
Right. Second, that high-return reinvestment opportunities remain endlessly abundant, that they can just keep finding $10 million bowling alley software companies forever.
Which we know is getting harder, hence the Altera deal.
Exactly. And third, that Mark Miller and the new management team will execute with the exact same unemotional precision as Mark Leonard, even as the scale and complexity of the targets increase exponentially.
The market is assuming the future will be a flawless continuation of the past. But, to ensure we are presenting a balanced view, we must acknowledge the broader consensus. The report cites Morningstar's analysis, which represents the standard bullish case on Wall Street.
Let's look at Morningstar.
Morningstar places the fair value significantly higher, around 3,600 Canadian dollars per share. They assign Constellation a narrow economic moat, but the key driver of their valuation is their use of a very low-weighted average cost of capital, or WACC. They set it at 7.4%.
And the discount rate, or WACC, is the absolutely critical lever in any valuation model. It represents the rate of return an investor requires to take on the risk of the investment.
Right. It's like the hurdle you have to clear.
Exactly. A 7.4% discount rate implies a remarkably low perception of risk. From the perspective of the skeptical buy-side framework, that rate is simply unjustifiable given the realities we have discussed today.
Because it ignores the regime change.
It ignores everything. When you apply a rigorous risk assessment, you must immediately raise that discount rate to between 9 and 10%.
Let's break down exactly why the discount rate must be penalized. Let's make that tangible for the listener.
Okay. You elevate the discount rate to mathematically account for the specific uncertainties that Morningstar's model glosses over. You add a premium for the key person transition risk following Mark Leonard's resignation.
Sure.
You add a premium for the escalating accounting opacity created by earnouts, provisional allocations, and complex non-controlling interests.
Sure.
And you add a premium for M&A execution error, the tangible, real-world risk that integrating a $725 million healthcare platform will yield significantly lower returns than acquiring a dozen $5 million niche software tools.
Okay, so using that higher skeptical discount rate of 9 to 10%, the report runs a detailed discounted cash flow, or DCF, model based on that $1.68 billion of free cash flow. And it models three directional outcomes: a bull case, a base case, and a bear case.
Let's walk through those. In the skeptical bull case, assuming everything goes perfectly, the intrinsic value lands at roughly $2,379 per share.
Okay, so there's upside from today's price of 18.20.
There is upside, but achieving that upside requires M&A excellence to persist flawlessly post-transition. It demands that Mark Miller matches Leonard's brilliance perfectly, that capital deployment remains highly accretive, and that margins are entirely defended against inflation and customer pushback.
So there is upside, but it requires them to essentially run the table against mounting odds. What about the base case? That's arguably more instructive.
The base case models a scenario where discipline largely holds, but the sheer pace of M&A moderates slightly due to increased private equity competition and just the sheer friction of larger deal sizes.
And under the base case assumptions, where does the model value the stock?
Approximately $1,618 per share.
1,618, which highlights a critical vulnerability here.
Yeah.
Because the base case value is 1,618, but the stock is currently trading at 1,820 today.
The current market price has already outrun a realistic, rational assessment of their future cash flows. If you purchase shares today, you are actively paying a premium for an outcome that is materially better than the most likely base scenario. You are paying heavily for optimism.
And if that optimism proves unfounded, what's the bear case look like?
The bear case models a scenario where the internal rates of return on new acquisitions compress significantly due to bidding wars, while organic growth remains sluggishly stuck at 3%.
What's the number?
In that scenario, the intrinsic value plummets to roughly $1,056 per share.
Oh, wow.
Yeah, if the compounding engine sputters, you have absolutely zero margin of safety at today's prices, and you face catastrophic downside risk. A contraction from 1820 down to 1056 represents a permanent loss of capital that is very, very difficult to ever recover from in a portfolio.
It sets up an asymmetrical risk profile, but skewed in the wrong direction for a new buyer today. It's akin to a coin flip where heads wins you a modest gain up to 2,300, but tails results in a devastating drop to 1,000.
That is the ultimate message embedded in the multiple. It is a phenomenal compounding machine, yes, but at this specific price point, it carries severe downside asymmetry.
So getting highly practical for a financially literate investor managing their own portfolio, if we agree this is an incredible cash generation asset that is simply mispriced today, how should one actually size this position without exposing themselves to that downside risk?
The report outlines a highly disciplined entry and exit framework, treating Constellation as a valuation-sensitive compounder. You acknowledge the quality of the business, but you just refuse to buy it unless it goes on sale.
What does that look like in practice?
A starter position of perhaps 1 to 2% of a portfolio is logical, simply to keep you mentally engaged in tracking the quarterly filings, but you should reserve a full 4 to 6% portfolio allocation strictly for a meaningful price dislocation.
A dislocation, meaning a broader market panic that drags the stock down, independent of Constellation's actual operating performance.
Precisely. You want to buy when macroeconomic fear compresses the multiple. But your review of the underlying filings confirms that customer churn is stable, debt covenants are untouched, and capital allocation discipline remains rigid.
What's the alternative entry point?
The secondary entry point is temporal. You just wait. You accumulate shares only after Mark Miller has delivered multiple quarters, or ideally years, of undeniable post-2025 cash durability.
Let him prove it.
Let him prove it. Once the new regime proves its competence, the risk premium naturally shrinks, which justifies paying a slightly higher entry multiple later.
Okay, what are the hard exit rules? If an investor owns this today, right now, what specific signals mandate an immediate sale?
You must liquidate the position immediately if structural IRR decay materializes in the filing.
How do you spot that?
You track the relationship between total acquisition spend and free cash flow per share. If you observe management deploying billions of dollars into new acquisitions, yet the free cash flow per share stagnates or declines, it is mathematical proof that the returns on those new deals are failing to clear the cost of capital. The engine is effectively flooding.
They are buying empty growth at the direct expense of profitability, just building an empire.
Exactly. The second unyielding exit rule relates to corporate communication. You sell the moment management shifts their narrative to justify growth over strict discipline.
Listen to the earnings calls.
Yes. If the earnings calls transition from a strict focus on ROIC to, making excuses about needing to acquire lower return assets for strategic positioning or total addressable market expansion, the culture drift has fully calcified.
The moment they begin sounding like a standard Silicon Valley growth company rather than a ruthless capital allocator, the thesis is broken.
Run for the exits.
Well, we have journeyed deep into the mechanics of this compounding machine today, navigating the opaque accounting and the shifting structural risks. Let's synthesize the core takeaways for you, the listener, as you evaluate this framework on your own.
Let's recap.
First, Constellation is undeniably a historic capital allocator.
Yeah.
However, their headline 15% revenue growth conceals a heavy reliance on continuous acquisitions to offset a sluggish 4% organic growth rate.
It's a shark that has to keep swimming.
Second, the departure of the architect, Mark Leonard, introduces a massive, largely unpriced regime change risk. The burden is entirely on Mark Miller to prove that the company's famous capital discipline will survive without its founder at the helm.
Third, their solution to the problem of excess cash deploying capital into massive, complex mega deals like Altera and engineering intricate spinouts like Topicus, well, it threatens to dilute the exceptional returns they achieve through their historical playbook of buying tiny niche software companies.
And finally, at a mid-20s cash flow multiple, the market is pricing in sustained perfection. This leaves an incredibly thin margin of safety, creating asymmetric downside risk if the M&A engine stutters even slightly.
Connecting the micromechanics of their business to the macro evolution of the market, I want to leave you with a final provocative thought.
Go for it.
If Constellation's ultimate competitive moat was never a proprietary software product, but rather a unique culture of decentralized capital allocation under a visionary founder, what happens over the next 10 years? Today, private equity firms are deploying massive funds armed with sophisticated artificial intelligence tools designed specifically to scrape data and source niche deals globally. What happens if algorithms perfectly reverse engineer Constellation's once secret VMS playbook? Can a process-based moat survive when the rest of the market learns and then automates the exact same process?
That is the ultimate stress test they will face in the coming decade. Thank you for joining us on this deep dive into the source material. We hope this framework empowers you to look past the top-line narrative and interrogate the underlying cash realities. Keep applying these frameworks, keep looking for the mechanisms behind the numbers, and always keep questioning the consensus. Until next time.